name's Mark Whitten. I'm the MD of Kaizen Asset Management. We are a boutique alternative asset manager, currently managing around 60 million rand. We run a multi-strategy hedge fund which invests across stocks, commodities, bonds and currencies, although the core of the portfolio is long shorts equity. We've been around since 2010. We've got just over a 2-year track record. We were up in our first year 25% versus the market that was flat. And yeah, we've just started adding some people to our team. We've hired Hubert Steenkamp, who's a fixed income analyst and with a background in quantitative finance. And we've got a young lady, Stephanie Kaufman, who's joined us also from Cape Town, dealing on the equity analysis side. Basically, the fund is split into 3 buckets. We have a fundamental bucket, which has a longer term focus and deals essentially with reversion to mean between asset classes or between asset prices. This is the bucket where the majority of our gearing's in and the majority of our longer term bets. Within that fundamental bucket, there'll be as many as 8 different strategies. So we'll have sort of an interest rate play, we'll have a rand hedge play, we'll have financials, industrials, retailers, etc. We have a second bucket, which is more of a short-term trading bucket, where we take advantage of short-term anomalies in the market, and we tend to trade top 40 futures against some of the larger constituents of the top 40 to look for what we call portable alpha, but maximizing beta volatility. And then we have a third bucket, which is an opportunities bucket, where if there's any M&A activity, like when Remgro unbundled Implats, that was a trade we took part in. When First Rain unbundled Momentum MMI, we took part in that trade. So those are the 3 main strategies, and the way we tend to put the portfolio together is we're constantly doing macroeconomic analysis, so it's top-down focused, the macro point of view. We then distill that into the industries we like, the sectors we like, and then at the background behind that, we're always doing fundamental analysis on the equities and the companies. To monetize it from South Africa, you tend to have to do the fundamental analysis and do some stock picking from there. And we're always very mindful of the currency, as well as what the foreigners are buying and selling, because our market tends to be driven more on the macro from the foreigners. Our talent is definitely managing money, not so much managing client relationships, which is why we partner with the likes of Vunani and with companies like Bayswater Capital, etc., where they take care of the capital raising, so we can stay focused on doing research and trading. We do interact with clients. We're more than happy to do monthly presentations, etc. From our point of view, I think our fund tends to run a bit more gearing and a bit more exposure than most traditional sort of bigger hedge funds that have been around for a while. So we don't see risk as volatility. So when the markets are volatile, our returns are volatile. We don't see, because we've had months where we've been up sort of 12. Our worst drawdown has also been 7. So for us, risk is risk of permanent capital loss. So if somebody doesn't have a sort of stomach for volatility and is very conservative, I think that our fund would make them a little bit nervous. On the other hand, we do believe, if you look at what we invest in, liquidity to me is a big risk. We don't invest ever anything outside of, let's say, the top 50. So there's no illiquid counters. Our entire fund can be reduced to cash in distressed market conditions in less than 12 hours. So, from that point of view, we don't see our fund as high risk, but you have to take a slightly longer term view. And judging us on a monthly basis could prove difficult. I think quarterly to semi-annually is how you want to judge our sort of fund. I think we've seen over the last year, you've had a big divergence between the financials and industrials, the Findy, which has been very strong, and the resources have been, they've been really hurt as the tightening in China. So they're sort of over-tightened in China on policy, and obviously all the problems in the Eurozone have continued. There's been a bit of a ripple effect now across through the US and the emerging markets. So, there's a glaring trade in that the Findy seems very overbought and the Resi seems very oversold. The resources are trading at almost a 50% discount to their historical means. But I'm not sure if that trade's going to close anytime soon. So, we generally, the kind of companies we like to invest in are not cyclical. We like companies with very defensive business models that'll benefit regardless of the economic environment. We're especially cognizant of cash flow and, balance sheet, strength of balance sheet, and management. So we tend to favor the defensive industrials, more than the cyclicals. We've often traded the cyclicals, so I think from our point of view, we would not be going short the Findy, but we would be lightening up on some of the financials industrials. We see Warren Buffett recently in his latest update for Berkshire has been paring back on some of the consumer counters, increasing his exposure to banks, which we are as well. And we've got a position in the resources because it's quite hard now. I don't think this market's going to be able to push higher, even if you see a lot of policy intervention in Europe that's keeping bond yields low. I'm not sure the market's going to push higher without the resources joining the party. And in fact, today is the first day I've seen the likes of Anglos and Billies and Sasol, etc., pushing up while the rest of the defensive industrials are coming off.